Peter and Art, I don't know if you understood any of my Hebrew, but I tried to give a really short update on the last 6 months, mostly talking about things that you and I have spoke about, what's been going on in Israel, and some of the international feedback and backlash. I shared the letter that both of your firms have signed, and how important and tremendous this support means to us. So with that, I want to have each one of you introduce themselves in a few words. We'll have more time during the next half an hour to dive more into the actions and some of your strategies. Art, because you were here on time, Peter was joined us in the last minute. You go first.
Hey, what's up? Art Fry, President and CEO of Spalding and Sly Investments. I've been with Spalding and Sly since 1998, involved in running the investment business on behalf of our investors.
Excellent. Peter? Peter, you're mute. You're on mute.
There we go. Sorry. I'm Peter Merrigan. I'm the CEO of Taurus Investment Holdings. We're based in Boston. And we've been working with Profimex now, I think, let's start for 20 years, maybe. It's been quite a while, and done countless deals together. And I just want to make a quick comment on behalf of everyone from Taurus that we're, deeply empathetic for everything that everyone has been going through there since October 7th. And really our hearts and minds are with you over here. And I know that's not the topic of this conversation, but I just wanted to express that from the Taurus side. Thank you.
Thank you. We appreciate that, and Art, you as well. So one of the things that Israel is known for is the startup nation and this sense of entrepreneurship. And one of the things that Israel has been criticized for is that many times when companies grow, they lose that sense of entrepreneurship and become kind of these very heavy institutional companies. Both your companies, I think, enjoy both sides of being still very entrepreneur, but also institutional. You've been able to work and partner with very large investors who require very high level of underwriting and report. Can you tell us a little bit how you hold kind of both sides of the stick? And by the way, someone asked me this week, why do you say you can't hold both sides of the stick? It's actually pretty easy if the stick is not so long. So I have to find that out. So Peter, let's start with you.
Sure. Yeah. I mean, so just to give you a little perspective on Taurus, we've done around 12 billion of investments over the years, and really since 1997. So, and some of that is with large institutions. Actually, a fair amount of it is. So you can coexist with both, family offices and conventional private investors, which is really sort of our bread and butter business. And then also married up with institutional players as well. So we've been able to do that since the first deal we did like that was actually in 1998 with Invesco. So we've been working with institutions like that for many, many years, and it's fairly common here in the U.S. and it's not difficult to do both.
I agree, and similarly, I mean, we've had programmatic relationships with large institutional partners. CalSTRS, we did four funds with CalSTRS. It was a very targeted investment profile. The structure that we maintain internally is one that allows us to focus our time and attention where we believe it's the best opportunity to get above risk-adjusted returns. That allows us to kind of be more nimble and move where institutions can be a little bit more static sometime and stay focused in particular geographies or segments of the market. It allows us to kind of move at where we think the opportunities exist and then find the right capital partner, whether that's private high net worth, family office, or institutional. So you need to, even though you have an entrepreneurial structure and mindset, you still need to understand the mindset and the structures of your counterparties, of your partners, and be able to relate to what their experiences and what limitations they have within the organizations.
So you talked a little bit about maximizing returns, Art, and I think between 2010 and 2020. I don't want to say it was easy to achieve these alpha returns, but it was easier than what it was before that and in the period we're now. So we're in these 2-3 years of a lot of economic uncertainty between rising interest rate, inflation, the war in Ukraine, and now we have elections coming up in the US. What are you doing to maximize your returns, and what changes are you making in order to face this period?
Peter, you want that one?
Oh, you want to give me the easy one? Look, I mean, basically what you have to do is protect your existing book of business. That's job number one. You know, I guess we have probably about 60 partnerships in operation right now across, you know, we're active in the US and Europe primarily. And so we have to make sure that the existing book can survive and thrive, hopefully during a period of volatility, as you described. The biggest problem, obviously, is the interest rate issue. You know, by and large, the net operating incomes across our portfolio are holding their own. Occupancies are okay. You know, expenses are higher because of inflation in various sectors, particularly insurance and taxes and some other things, and labor. But generally speaking, we're able to keep the net operating incomes pretty close to what we had targeted. But 500 basis points of rate hikes was not in our pro formas. And we did have some rate hikes in there, but we didn't have that level. And so managing and hedging and working through that and protecting your assets is the biggest thing. So that's for the existing book. If you look at going forward, where I think the kind of opportunistic returns will be, our primary sectors for Taurus at least is in industrial and multifamily. Industrial, we don't do conventional industrial like big box type of stuff, new development. We mostly do last mile industrial. We think that's a very defensible asset class because no one builds it. So you don't have, it's the only asset class that I know of in real estate where you don't have a supply side risk. And the tenants need to be close to the population. So they really can't move into bigger box facilities. They need to stay in either your building or another building like yours. And our occupancy in that portfolio, which is about 20 million square feet, is roughly around 99%. It's very unusual in any asset class to have that kind of dynamic. So we think that there's still going to be pressure going forward in that kind of last mile industrial sector. And we will still have a strong conviction around that for delivering high returns. Where I think that there's a highly opportunistic play going forward, which I think I think you all saw this yesterday with Blackstone's major bet in multifamily. They made a $10 billion allocation into the multifamily sector, which they have not done in other sectors recently. So Blackstone, not to speak for them, but they're really not value add players. They're market players. They make market bets. So their market bet that they made yesterday was on multifamily as being probably over penalized, mispriced a little bit. They could buy that at, say, a 6 cap or whatever the number it turns out to be at the long run. And they think that that's a good bet. I happen to agree with them. I think that multifamily is getting overly penalized because it's facing a big supply wave and a big interest rate hike at the same time. And with short-term loan maturities that are causing a dislocation in the market, that's going to change and burn off over the next couple of years. So I think opportunistically going forward, we have a pretty strong conviction that multifamily is going to offer the best opportunities in the next, say, 12 to 24 months.
Art, what about you? How are you preparing for the volatility in the market?
So I agree with Peter in terms of first take care of your house, right? Make sure that you do everything you can with the existing portfolio. That's how you get long-term successful track records for your investors, and how you have your investors come back to you time and time again. So that's the major focus, and those are the investments that are most challenged because, as Peter said, with the 500 basis point spike in interest rates during your whole period, plus everybody says every downturn is different, and the reality is they are. This one is particularly interesting because it's not just a real estate downturn, or a macroeconomic one, it's really psychological in a lot of ways, especially as it relates to office, but in other asset classes, as Peter mentioned, in industrial and multifamily as well. There's just a shift in the mindset of the end consumer of real estate, whether that's housing or whether that's industrial or office. And that's been hard to navigate, quite honestly, because understanding the psychology behind what's driving demand and where and in what segments and what geographies. There's been a shift in the U.S. It was already occurring in terms of businesses going to jobs versus jobs going to businesses, which was kind of how it was, in the 50s through kind of the 90s, where folks would, go to an employer that was in California if they were in Washington, D.C., because that's where their job was. And then you started to see that shift, folks moving their headquarters from a location to where the talent was. And then you overlay that with the migration that was occurring, sort of the quality of life, cost of living migration that was occurring more gradually from some of the northern markets down to the south. That was put on steroids. That was amplified by the pandemic. It could geopolitically, but not get too deep in in the South. COVID didn't exist in most parts of the South in the U.S. They didn't really follow a lot of the mandates. They didn't hold them very, very near and dear for very long, if they held them at all. And so people were leaving the northern climates, northern section of the country, and migrating south. There's also a lot of incentives that are in the kind of right to work states that are attracting businesses to the same place that people were naturally attracted to because of the cost of living and quality of life components. So there's been this philosophical and psychological shift that you needed to kind of overlay with your acumen and understanding of the fundamentals of real estate. And I think the theme that I would say is most important is discipline. Discipline in your underwriting, discipline in where you spend your time and energy, and as much as what to lean into, as much as to what to move away from, and do so timely, so that you don't find yourself in a tough situation.
You spoke about underwriting, and we live in the age of information where there's a lot of public information that's available, and still each one of you has unique attributes and unique access and approach towards research and proprietary information. Can you tell us a little bit how you approach the underwriting process, and if you have your own research that you do on your current assets as well as on potential new assets?
Peter, I'll go first on this one.
Go.
So we're not as large of an organization as Peter's, but we do have in-house research capabilities and leverage those. A number of my colleagues are professors at various different institutions. One of them is actually an ad hoc professor at MIT, and he is very focused on research, and we base our investment focus, and it's very research driven. And we kind of lead with that, and then we augment our own research and our own beliefs with that of third parties to try to triangulate and determine where we think those best risk-adjusted returns can be achieved in the then current market. Back to the entrepreneurial approach, we can pivot. So we can make a decision and read the tea leaves as we're working on our investment, and decide to move off of that much more quickly than most, which allows us not to get in a situation where we ascribe to a particular asset class or market. It also allows us to determine how to hang on, go along with particular investments, or to get out quickly if we see the pendulum shifting.
Yeah, thanks. So maybe the easiest way to explain it is maybe to quickly explain the way Taurus is organized, because I think that might be helpful. So Taurus is, I'm the CEO and I'm a generalist, right? So I'm kind of know a little bit about many different things, right? So, but and that's why I give the strategic direction around markets, around opportunities, around strategies and things like that. But the execution and the research level beyond just kind of the macro picture, which I focus more on the macro picture, is done by the industry experts that we have. So we're divided into divisions. So we have a multifamily division, an industrial division, an office division. So and then we have geographical focuses in the UK and in Germany in particular. And we have an expert that focuses on each one. So the multifamily person does not care or do anything with industrial. Neither does the industrial one do anything about multifamily. All they focus on is their discipline, and so what they do is a deep dive from a research perspective within their particular area of expertise. And that comes from lots of different sources. You know, we have many third parties that we're engaged with. We have relationships with groups like MIT and Harvard, et cetera. But you're digesting all this information coming from multiple different places. But then it's really on the individuals on the ground, where I find that the best opportunities are coming from our expertise in-house on the ground, because we're living and breathing it every day. So if you're digging up a multifamily deal or an industrial deal, you know, they're looking at 100 different ones at the same time. We're operating thousands of apartments. We're operating millions of square feet of industrial. We kind of know what is going on within the local market. We know what's going on within our local portfolio, and we get the best inputs really from our own operations. Because we know real time what's happening on the ground. Now, because a lot of the research that we do get is somewhat backdated, you know, so if you go to CoStar, if you go to places like that, it's looking backwards more. I mean, it does try to look forward, but usually it's wrong. What we find is that by the time all that information comes out, it's kind of outdated. So what we like to do is really focus on our on the ground operations and try to build off of what we see real time.
Well, in addition to that, Peter, it's also sometimes very biased, depending on who's authoring
For
the
sure.
information.
Yeah. I mean, so on the macro side, I don't know if people are interested in this. So one group that I do subscribe to, which I find somewhat interesting and valuable, is the Pantheon group from a macroeconomic standpoint. Because again, that's my focus, is more the big picture. And they've been I find them to be very helpful and insightful because what's happening is that in this kind of media cycle that we live in with all these different inputs, as you described us up, you know, everyone is so reactive to the day's news, like the 300,000 jobs on Friday. Oh my God, everyone like loses their mind over that. But you have to look at the trends, and you have to look at what's really happening under the hood. And if you just look at the headlines, you can draw the wrong conclusion. So that's why I try to do a deeper dive on that kind of stuff and really understand what's going on.
I appreciate the fact that you both touched on some of the similarities, and obviously both of you have tremendous track record and are excellent and really leading in what you do, but also that you're very transparent and upfront about some of the differences. So I want to touch a little bit about some of the unique attributes, and I'll start with you, Art. One of your focuses are mid-cap assets. And can you talk a little bit about the advantage of pursuing that type of asset, and what does it even mean, mid-cap assets?
So we intentionally focus on what I call small to mid cap. So aggregate deal sizes between as low as 5 million to kind of that $60 million level. The idea being to be able to create some value, and it comes in a lot of different shapes and sizes, and sell it into the institutional space. So there has to be some pretty significant components that you can either a view you have into the market that you don't believe is understood by the masses, or an execution component. We do everything from buying dirt and entitling it, stabilizing it, and selling it, to buying stabilized assets where there's some fundamental disconnect in terms of its operations, and or a component where you can increase its density or reposition it through entitlements and sell the existing improvements with some upside for repositioning. So some additional layers of complication in terms of execution. We have a team that's made up intentionally of very diverse backgrounds and capabilities. Design, architects, engineers, business majors, finance majors. We have our own in-house counsel. So we kind of try to leverage all of those different perspectives and expertise to find those opportunities that have a little bit of hair on them, where with our capabilities and expertise, we can refine those opportunities and then position them to sell them into that institutional space, ideally with some compression in terms of what we bought it for versus what somebody acquires it. We're also, the deal size limits the buying pool, and so the old expression, you make your money on the buy, is there's a reason why that expression exists, because it's true in most cases. And most institutional equity or larger investors, it's inefficient for them to invest used to be less than $20 million per transaction. That's kind of come inboard a little bit given the scarcity of good investment opportunities. But nonetheless, that kind of mid-cap space allows us to be in a less crowded realm. And because of our more institutional structure combined with our entrepreneurial approach, we present very well to those mid-cap sellers, where we can differentiate ourselves other than on price.
And Peter, one of the focuses of your organization is net zero and sustainability. You've been one of the leaders in this market, pretty early adapters. Can you talk a little bit about how that differentiates you from your competitors?
Yeah, it's actually interesting because it has proven to be a differentiator, particularly with institutional investors. But we took a different approach on it. We looked at it as a value add strategy, not as just doing it for the sake of sustainability. So, for example, when we go into a project, I think you guys Profimex was investing in our Columbia 191 in Southwinds, where we went in and did a full, sustainable retrofit of that project. We were able to add a lot of value, and the simple math on it was we put in net after incentives about $10 million of additional cost, and we were able to improve the NOI by about $800,000. So about an 8% unlevered return on cost for that energy sustainable retrofit. And then we were able to sell it at, roughly a 5.6 cap. So it's accretive, right? So it adds value. It's like the same as going in and doing fixing up the lobbies or fixing up the kitchens and baths, whatever. It's just a different strategy for us. The one thing that we had to do, though, in order to make it effective, was we felt that we needed to build out our own team to do that. So we have around 15 people who are energy experts in-house, and they develop strategies for each asset that we acquire. And so, and then they develop an energy plan where we can, and then we delete the things that don't add value, and we do the things that do add value. And so it's not that we're trying to do decarbonization for the sake of decarbonization. We're doing it to create a better asset and a better financial result. So that's part of what our strategy is. You'll see that, wrapping around all of the assets that we buy. We do that every single time. So it is a bit unique for right now. I do hear about more people that are starting to enter the space, but lately it's in the recent past has really been mostly us doing it, which is why it's gotten a lot of attention. One of the things that, just to finish up on that thought, is that one of the things in real estate, which is that people look at things, it's kind of a long-standing business. It's not incredibly innovative as an industry. So you have to show people, you have to have proof of concept, you have to demonstrate the results real time. And so what we did was we did our project in Whisper Valley, which is a new build, and we did our Novo project called Avian Point down in Orlando, Florida, and then we did Southwinds and on and on and on. Well, we can actually measure the energy success that we've had and net operating income success that we've had, and demonstrate that to the clients. So it's been a, as I said, an accretive strategy that's worked so far.
So in a low interest environment, it's I don't want to say that it's easy, but it's easier to get high results, even if you don't do something special. But in the environment that we're in, you really have to roll up your sleeves and look for these opportunities and work really hard. And both of you mentioned part of your strategy to do that, and I appreciate that. And everyone has been waiting for this kind of shock and a tremendous downturn, but it seems like we are facing some sort of a soft landing at this point. What are you seeing as the most attractive and risk-adjusted returns in real estate opportunities right now. You can talk about sectors, you can talk about strategies, you can talk about locations, and you touched a little bit about them, but if we can just really focus on this specific environment we're in right now, and maybe if you want, touch also on the upcoming elections in November.
Another easy topic.
No, that was a loaded question. There was like a question with 10 parts. I'll jump in. I'll leave the politics to Peter, but I'll jump. I mean, I think Peter touched on it earlier. I mean, the last mile in, infill industrial, I think very defensible position, a really attractive risk-adjusted returns. It's not, home run returns, but when you're in markets like we're in now, where the direction, albeit stabilizing, unclear as to when and to what extent rates recede, because of the robust nature of our economy, which is being fueled by the onshoring and nearshoring, and intentionally so, which is the net job gains in those sectors are more than offsetting some losses in others. And so you really need to be very careful about where you're seeking those returns and what constitutes a good risk-adjusted return in the particular market in which you're choosing to invest. And so I do like that infill industrial play a lot. I agree with Peter 100% about the multifamily, and that there's some mispricing that's occurring there that leads itself to, I think, quite a few opportunities. We've been seeing them ourselves. And I think it is short-lived. With higher interest rates, the borrowing cost and the cost for ownership is out of reach for a large portion of our population, which then puts more upward pressure, or at least stabilizes, and ultimately upward pressure on multifamily. And there is a point in time that's occurring right now where there's a disconnect between values that are being achieved today versus what I think the long-time value for multifamily. So the first time in a long time, I think you can get value add to opportunistic returns in multifamily if you pick your spots and you're patient and you capitalize it appropriately. I think there's real opportunity. The last one that I'd say that we see opportunity is in dirt, in those markets where the fundamentals are strong and getting stronger, given our pedigree and our capabilities on the development side, being able to acquire ground and spend the soft dollars, the design, the engineering, on paper. Paper is a lot less expensive than sticks and bricks, right? So to use this time where a lot of capital has their hands in their pockets because they're not sure where to go, to be able to acquire land at a lower basis because of the uncertainty in the economy, and use this time to position it to go vertical when capital wants to push back into the market. And so we see that as a pretty significant way how we'll make some attractive returns over the next few years.
Yeah, I mean, I don't disagree with any of that, actually. I think that it's, land is getting really hit from a valuation standpoint, but you can add value with entitlements. And so that's certainly, if you have that expertise, you're going to be able to deliver some outsized returns there. Let me get a little more granular on the multifamily opportunity as I see it. And I agree with the last mile stuff we already talked about. But on multifamily, what I think is that before, if you were Taurus, you couldn't really buy Class A and make any real return at it. They were kind of core assets. They were, they priced in kind of the 4s or even sub-4 cap rate. Now you can actually buy them, and some of these ones are in lease up that are stalled, that the merchant builders have to exit, that type of thing. You're going to see some very opportunistic buys up market, which were not available before. And if you think about this, what you can do in some cases, you're able to buy these assets for significantly below replacement cost. So you're getting the asset without the development risk, without a land price, for less than it costs to build it. So that's, and it's Class A, it's brand new. So that is, to me, is a short window. That's just entirely a function of the dislocation of the market. So our strongest conviction going forward, always last mile industrial, because that's what we've done since the beginning of the company. And then going after that dislocated Class A product right now in the multifamily sector, which we think is just a highly opportunistic play that is going to be a fairly short window.
And I have a question that came from the audience. How do you take opportunities, or how do you take advantage of opportunities where there is a short window? So if I understand the question directly, how do you find them quickly, and how do you execute on them?
Yeah, and by the way, we've really successfully dodged your political question, so that was quite. I think we deserve credit for that.
I'll answer it. I'm Israeli.
So the one thing on the political side, not to get into politics just for a second, is that what is somewhat very political here in the U.S. is the immigration situation. What's weird about that is that is actually part of what's powering part of the job growth and the city, growth, et cetera. So it's kind of it's a weird political thing, which is probably, maybe it's going to change in November, who knows, but it's one where that's probably, if you were to ask a topic in the US, and the US is very inward focused, as you know, immigration, illegal immigration is probably one of the top topics that will have a significant play in the election going forward. And it's going to have, whatever comes out of that is going to have an economic impact as well. So it's something to keep an eye on.
And maybe for some of us on the call that are not very connected to U.S. politics and real estate, I think some of the things that have affected real estate are the ease of doing business. So in states where it's easier to do business, you see more employment, more businesses, and it's also easier usually to get permits to build more. The second thing is crime, which really affected some of the blue states, the democratic states, like California, where it's people have really been kind of running away from there. And also rent collection, which has been affected by some local legislation that has made it very hard. We see properties where on the books you have occupancy of over 95%, but economically you're only collecting 80 or 75% of the rent.
Yeah, that's a real issue. I mean, that's not, and that's more of a state political issue than it is a federal political issue. But because remember, the federal government doesn't manage these individual states and cities. But you're right. I mean, there's been a lot of problems in those particular cities. And you didn't mention taxes, which is another huge burden that's being placed on the businesses in those environments. So yeah, it is definitely a challenge. Now, having said that, there's certain infrastructure within some of those blue states, like educational bases and other industries, which are very sticky, which will continue to drive growth. So in Boston, for example, where we're from, you have Harvard and MIT, and they're going to continue to drive job growth here. So
it took you 40 minutes to mention Harvard and MIT.
Well, they're here.
He did Harvard. I heard him.
Oh, he did. So I'm just going back to the question that someone asked before. Yeah, sure.
Can I jump in there real quick? I mean, I think the other dynamic, which is interesting, is the same things that are hurting the northern states, the barriers to entry, the more less business friendly, to pick an analogy, is actually helping shore up current values. So it depends where you are in the life cycle of your investment. I mean, Peter, we have a multifamily we just delivered up in Arlington, Massachusetts, which is a kind of a very infill kind of first tier outside the city of Boston. That we're, because of the NIMBYism, which is not in my backyard, which is an acronym that's used quite, and the lengthy and complicated entitlement processes in places like Greater Boston and others, including the district, Washington D.C. area. You don't get surprised by a lot of the supply, the ebbs and flows of supply and demand you see in some of the southern markets. So although it's easier to do business there, and it's presenting some opportunities on the buy side, as we've already talked about in the multi, because of the easier nature of delivering product, it means you get this flood of product and then demand has to catch back up and then you rinse and repeat, right? But in the northern markets, it's a little more steady eddy. And so capital, especially institutional capital that's core plus in nature, is focused more on the durability of a particular asset and its income stream than the bigger pops in terms of valuation. So it really depends. You get where you are in the evolution of your particular investment, whether you're getting in or you already own it, in terms of how you look at positioning that and making attractive returns.
Yeah, I think that's right. The supply side is much more restricted in those northern markets, and if as long as they have reasonable job growth, then they'll continue to to do okay. To address the question that was asked, I think we kind of skipped over it. So and this may sound a little self-serving, but to talk about how do you take advantage of those opportunities quickly, it's really because you have the expertise to do it, and you have the in-house people that there's no learning curve. There's no, hey, all of a sudden I'm going to be a life sciences expert, and I don't have any life sciences expertise. This is something that's just changing your strategy within an asset class that you already are an expert at. And so that to me makes it very easily to just really just kind of shift your focus a little bit within the same sector, and take advantage of it. Again, I don't think the window, talking about multifamily, is open very long, but I think it's fairly easy to become very active in that space, at least for us, because we do it all the time.
Art, any advice on taking advantage of short-term opportunities or short windows?
I agree with how Peter framed it. I mean, we're in those markets. We see it day to day. So it's from our perspective, it's more about because we don't have a large amount of capital to invest on our own. We rely on partners like Profimex and others to capitalize deals on the equity side. It's been more of a challenge to get the capital to understand this window that Peter's describing. Everyone's trying to find the floor, and you'll never find it. And so, unfortunately, I think folks a lot of capital is waiting for the Fed to move rates before they flood back in. Where the reality is I think, I don't have a crystal ball like anybody else, but I do believe we've reached equilibrium in terms of no more rate hikes. And so I don't believe you need to wait till the movement occurs on the Fed side. I think once the movement starts to occur, whether that's the first rate reduction or the second or the third, your guess is as good as mine. It's going to open up the floodgates to more capital that it's sitting on the sideline and exists in ample sums that will start to close that window pretty quickly, as Peter described it.
Yeah, what I'd add to that is that in our opinion, what we've seen in the marketplace, and there haven't been tons of trades, so it's a little bit anecdotal, but is that there's been about 50 basis points of compression since December when the Fed pivot happened. When they started talking about reaching the top of the hiking cycle and starting to think about cutting. And once that psychology changed, right, we saw in the first quarter about that 50 basis points of compression in some of those assets. So it's already starting to get priced in, but it's not there yet. I mean, there's a big market. There's still plenty to trade, and there's a lot of people that their hedges haven't burned off yet on their floating rate debt. They may have some problems with refinancing, et cetera. So those kind of sellers have been able to hold on so far, but there's probably going to be more product that comes out in the second half of the year.
So here's a little self-serving for Profimex. We're ready. Our fund is well capitalized. We've already invested in a few deals with Toros. We've approved one deal with Art, with SSI. We've delayed it a little bit. Hopefully it comes back again later this year. So we are enjoying the benefit of sitting here with this well-capitalized fund, and our investors are going to get to enjoy the benefits of investing together with you. And on that note, I want to thank you for the time you spent with us today. I know one of you I'm seeing pretty soon. I won't say which one. The other one I hope to see pretty soon as well. And thank you again for your support. It means a lot to us.
Thank you, Sal. Thanks for the opportunity. Nice to see you all.
And you guys can stay, but I'm handing it over to Eyal, our CIO, who's going to spend about 15 minutes kind of recapping some of the things that you've said, but in Hebrew. So So we'll understand if you leave, but I invite the rest of almost 100 attendants to stay with us for this part.
Thank you, everybody. Thanks for the
We'll sign
opportunity.
up. Thank you. Bye-bye.